Welcome to the Stock Market Palantir. Today we are going to talk about PACB. Welcome to the debate. Few companies in the long-read sequencing space have generated as much intense, high-stakes discussion as Pacific Biosciences, or PACB. This is not just another stock. It's really an all-or-nothing bet on the future of genomics.
That's absolutely right. We're discussing a company that is navigating a really critical transformation in fiscal year 2025. It's shifting from being primarily a seller of expensive capital equipment, the big sequencing machines, to a supplier of high-margin consumables, the cartridges and reagents that actually fuel those machines.
And that transition is precisely what makes PACB such a textbook example of an asymmetric, or you could call it a binary option investment. So the core question we have to address today is this. Is PACB's future trajectory secured by the undeniable technological leap embodied in its upcoming SparkNex chemistry and the proven success of this razor and blade model, or is the entire venture fundamentally compromised by the immediate existential financial risks? I'm talking about a rapid cash burn rate and a market structure that seems, almost engineered to suppress its price.
And I will be arguing today that the financial fragility and the structural mechanics of how this stock trades creates an almost insurmountable risk barrier. The timeline required for the technology to achieve profitability, it simply clashes with their current cash position. And that fundamentally limits the stock's appreciation, regardless of how good the technology looks on paper.
And I'll be taking the opposing view, that the technological superiority and the accelerating shift towards sticky, recurring, consumable revenue, that it overrides these immediate solvency risks. This is a high upside opportunity, a true investment in the next generation of sequencing technology, what they call Genomics 3.0.
Okay, let's start with that technological optimism then, because I'll admit there is certainly a compelling story there.
My position is really grounded in the evidence that the operational pivot is already working. If you look at the third quarter of 2025, yes, okay, we saw a sharp 32.7% contraction in instrument revenue. That's the headline, right? The big boxes aren't selling. But that decline is, I think, secondary to the robust 15.1% expansion in consumable revenue. This is the crucial validation. It proves that the installed base, the Revio and Vegas systems they've already sold out there, is active, it's generating workflow, and it's consistently reordering high-margin reagents.
Okay. I concede the consumable growth is robust, but I would frame that shift as an indication of operational stress, not just a pivot. It suggests that while existing users are using their machines, new customers are really hesitant to commit to multi-million-dollar capital expenditures in the current macroeconomic climate.
But that hesitancy is about to be wiped out by the core technology, SparkNex. This new chemistry is a true game changer because it promises to bring the cost of long-read sequencing down to under $300 per human genome at scale. Historically, long-read was just prohibitively expensive and slow compared to incumbents like Illumina. This $300 figure, it's the economic weapon that wipes out the competitor's main advantage. It achieves cost parity with short-read sequencing, but with superior data quality, the so-called hi-fi data. This opens up the massive total addressable market, population-scale genomics, routine clinical diagnostics, which was previously just gated by cost.
That technological promise is, I agree, seismic, but promises don't pay the bills. We need to look at the immediate existential risks posed by the balance sheet, and the financial reality is severe. We are projecting a cash burn for the full year 2025 of approximately $115 million. Now, they currently hold about $314.7 million in cash and investments, but that figure gives the company only about, 2.7 years of runway if the burn rate continues unchanged? And that doesn't even account for the accelerated capital intensity needed for developing the next wave of Genomics 3.0 hardware. That is an extremely short fuse for a transition of this magnitude.
But management is actively addressing that burn rate. They're not just letting it accelerate.
They are, but the market's reaction is what matters here. The market is skeptical, and that skepticism is reflected not just in the low stock price, but in the structural dynamics I mentioned earlier.
40 to 50% of daily trading volume executes off-exchange in what are often called dark pools. This opaque trading, largely driven by institutional hedging strategies, creates a persistent price ceiling. Specifically, institutions are shorting the stock to hedge their exposure to the $459 million in convertible notes.
You're highlighting the volatility, but not the opportunity that same volatility creates.
No, I'm highlighting the structural dampener. And finally, we just cannot ignore the governance risk that spooked the market earlier this year: the authorization for a reverse stock split. The fact that this was even sought in the 2025 proxy statement after the stock hit a 52-week low of 85 cents, it remains a sword of Damocles. It creates significant psychological damage and frankly keeps potential long-term investors away.
Okay, this leads us naturally to our first point of contention, which is whether we should be prioritizing the quality of the revenue or panicking over the magnitude of the cash burn. You highlighted that Q3 total revenue of $38.4 million was lower than the previous year's quarter. I fully acknowledge the short-term top-line drag caused by their pivot. But my question is this: if a company is fundamentally changing its business model to focus on high-margin, sticky revenue streams, shouldn't we focus on the improving margin profile rather than the stagnant total sales figure?
We absolutely need to look at the margin profile, but we also need time. The development of new sequencers, this Genomics 3.0 hardware, is incredibly capital intensive. So how long can that $314 million sustain operations if the burn rate stays high while the total revenue stagnates? The quality of earnings is frankly irrelevant if they are forced into a deeply dilutive financing event right before Spark Next is fully ready for the market. They are caught in a race against the clock.
I disagree that the quality is moot. I think it's what buys them the time. The transition is rapidly accelerating. Consumables now constitute 55% of total revenue. That's up significantly from 46% just a year prior. That shift replaces lumpy, unpredictable instrument sales with predictable, annuity-like revenue. That's a massive shift in the risk profile. Furthermore, management is demonstrating rigorous financial discipline. The restructuring they implemented back in Q1 of 2025 was designed to cut $45 to $50 million in annualized operating expense. And that discipline is already showing up. The Q3 GAAP EPS of -12 handily beat expectations of -15 cents. They are actively controlling the burn rate trajectory, effectively extending that runway beyond your calculated 2.7 years and giving Spark Next the crucial time it needs.
Delaying the inevitable, perhaps, but the timeline remains highly constrained by execution risk. Which pivots us directly to the second contention: the power of Spark Next's technical edge versus the immense friction of market adoption, particularly in the clinical space. You tout the technical specifications, and yes, they are impressive.
I'd say they're more than impressive. They are revolutionary for clinical use. Spark Next offers key advantages beyond just achieving cost parity. Consider two major clinical hurdles. First, it achieves a 4-fold reduction in the required sample volume. This is absolutely critical in oncology when you're dealing with limited biopsy tissue, or in pediatrics where samples are scarce. Second, it offers native methylation detection.
So for our listeners who might not be specialists in genetics, why is detecting methylation natively, without damaging the DNA, why is that such a massive step forward for clinical research and diagnostics?
It's a leap in diagnostic power. Methylation is essentially the software layer that controls which genes are expressed. Anomalous methylation patterns are critical biomarkers for early cancer detection and complex diseases. Current methods require these destructive pre-processing steps which distort the signal. PACBio's HiFi technology detects the signal natively in its original state, making the data far cleaner and more powerful for clinical interpretation. And this superiority is already validated. The massive Korean Pangenome Reference Project, sequencing 1,000 genomes, chose PacBio as its primary platform. That project provides immediate, large-scale validation and predictable consumable drag well into 2026. This is blue-chip adoption.
Okay, that project is fantastic validation for the research sector. I agree. But the market's skepticism about translating that into high-volume clinical adoption is palpable. Just look at the institutional rating consensus. It's lukewarm at best. You have 4 buy ratings and 6 hold recommendations. The path to sustained profitability relies so heavily on clinical conversion, where the barriers are not technical, they are regulatory, logistical, and, well, often geopolitical.
You're talking about friction. I'm talking about a product that is so much better it justifies pushing through that friction.
But the friction is costly. Clinical labs are inherently conservative. They face high costs for revalidation and certification every single time they switch platforms. Their inertia is immense. And we cannot ignore the persistent China factor. Even with the NMPA approval they got via Berry Genomics, which does shift them from pure academic research into the clinical reimbursement system, China still represents a massive headwind. The Buy China geopolitical initiative continues to favor domestic suppliers, making it extremely difficult for technical superiority alone to overcome government purchasing bias in, the world's second largest market.
While the geopolitical headwinds are real, I would argue the NMPA approval significantly stabilizes the demand profile in China by tying it to the clinical reimbursement system. That's far more reliable and long-term than relying purely on academic grants. But let's shift focus, because this skepticism you highlight about the market structure, that is where the potential explosion lies. You view the structure as an anchor.
I see it as a structural ceiling that prevents sustained rallies. Let me detail why. As I mentioned, we have 40 to 50% off-exchange volume, which obscures real price discovery. The high reported short interest, about 32.5 million shares, often representing 4 to 6 days to cover, is problematic. But the key mechanical driver is the convertible note arbitrageurs continually shorting the stock.
Okay, could you clarify for our listeners exactly why the convertible notes compel these arbitrageurs to short the stock?
Absolutely. So these institutions, they buy the convertible notes, which are essentially bonds that can be exchanged for shares later, and then they immediately short the stock to hedge their position. It's called delta hedging. They are seeking a risk-neutral return on the bond interest, meaning they sell shares into every single rally to maintain their hedge ratio. This systematic institutional selling creates a constant structural dampener on the stock. It is why good news often fails to move the price in any sustainable way.
I acknowledge that structural dampening exists, but I argue that that same pressure creates an explosive asymmetric opportunity. That committed short base becomes a massive liability for them if the technology gains traction. The system of institutional hedging creates pressure, yes, but that pressure is inherently unstable and can lead to violent short squeezes. We have empirical proof of this instability.
You're referring to the recent volatility?
Exactly. Look at the SEC data. It shows significant spikes in failure to deliver, or FTD shares, in late 2025. For listeners, FTDs mean someone sold shares they didn't actually have access to. When the regulator mandates that those failed trades must be covered, it forces immediate buying into the open market. This FTD anomaly correlated directly with a substantial 13% surge on November 21st.
But that was temporary volatility driven by retail sentiment, not some fundamental change.
But it proves that regulatory-mandated forced buy-ins under regulations show can quickly overwhelm the structural selling from those delta hedging arbitrageurs. This validates the high-risk, high-reward retail thesis that views that massive short interest not as an anchor, but as rocket fuel. The smart money hedging activity in this scenario becomes a loaded spring for investors willing to endure the volatility, because the upside potential is concentrated and explosive if Spark Next gains momentum.
That upside potential is conditional on perfect execution, which brings us right back to the timeline. They are only exposed to that rocket fuel if they survive the 2.7-year runway.
Then let us summarize this binary conflict. I maintain that the structural risks you highlight, the high short interest, the dark pool activity, are merely volatility noise surrounding a massive technological inflection point. If the $300 genome promise materializes, confirming the bull case, which analysts currently estimate at about a 30% probability, the financial concerns will fundamentally evaporate. High consumable drag and sticky revenue will drastically accelerate the path to positive cash flow.
In that scenario, the stock is poised for a massive re-rating, likely into the $4.50 to $6 range. The strong consumable growth we've already seen validates the utility of the hi-fi technology, proving the foundation is solid.
I understand the potential for explosion, but I maintain the company is currently caught in a precarious valley of death. The timeline for achieving profitability with Spark Next clashes directly with a high, sustained burn rate that necessitates near-perfect commercial execution. The reverse split authorization remains a crucial governance risk that creates an investor ceiling, and the opaque market structure ensures that even genuinely good news is constantly tempered by that institutional hedging pressure. This makes PACB highly susceptible to the bear case, which is estimated by some analysts at a higher 40% probability. Failure to execute quickly will inevitably lead to highly dilutive events or perhaps a forced M&A exit at a lower valuation than the technology truly warrants.
So we agree on the core conflict. It's a battle between technology's potential and the immediate timing of financial reality.
We do. The future trajectory hinges entirely on the successful commercial launch of Spark Next. The current financial stability, extended by those OPEX cuts, is a reprieve, not a cure. The high-risk, high-reward binary nature of this investment remains the defining characteristic for any stakeholder examining the material today.
Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks, don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.